Today we're going to talk with not only the founder of ESS, but also the due diligence leads and participants in several of the different entities that invested at the very early stages. First, I'd like to bring Craig up to the stage. Craig, could you introduce yourself a little bit and talk about where you're at the moment?
Sure. So Craig Evans, founder, now president. So I've handed over the CEO reins to Eric Dresselhaus. Started ESS back in 2011, and we are now actively trading on the NYSE. So it was a fun event last Monday to have the team out in New York.
Yeah, go ring the bell. Yay. Keith, can you introduce yourself, please?
Yeah, sure. Hi, everybody. It is really fun being here and seeing so many familiar faces. I'm gratified to see a lot of you who are past SPAC and SPAC 6 investors joining today. And hopefully we'll be able to mingle and hear some questions and comments from you guys as part of this. So my name is Keith Lepley. I have participated in a bunch of SPAC rounds starting in fall of 2012. I think I did 6 Seattle Angel Conference rounds. I had the distinct pleasure and challenge of being the fund manager for Seattle Angel Conference 6 back in fall 2014. And for those of you not familiar with our program, what that means is I'm a volunteer, not paid staff. But I had the challenge and really the fun in the summer of 2014 leading into the fall of recruiting the 30 to 40 applicants who were coming into the Seattle Angel Conference fall 2014 program, what we called SPAC 6. And for those of you not exactly familiar, SPAC is a training ground for angels and entrepreneurs. We put everybody together. And we look at, we get a group of in this case, we had about 26 investors. And we spend 12 weeks going through pitches in PowerPoint form and in presentation form. And it's kind of a pitch, it's kind of a competition. And at the end of it, we pick 6 finalists who present at our conference at the end. And the investors choose one for our pooled investment to be awarded to. And of course, in fall 2014, SPAC 6, that was ESS after Craig's presentation and due diligence participation, which is what you're here to hear about. So I wasn't a member of the exact due diligence team, but I was paying attention to all of them, being the manager and organizer of the conference. And since I've been the fund manager in the 6 or 7 years since, that means I've been really paying attention to ESS. There have been documents and contracts and agreements to execute in a timely way as ESS has continued to go through its subsequent funding rounds and Series B and C, and now, of course, paying attention to it from the SPAC and eventual exit perspective down the road. So that's my background. And John, I think we're going to go through and introduce the other panelists as well, and then circle back and we'll talk about our original due diligence.
Yes, that's the goal. So Andrew, can I get you to talk a little bit about, introduce yourself and talk a little bit about Pangea?
Sure. Hi, everyone. So yeah, my name is Andrew Hyan. So we were actually the lead venture investor on the ESS Series A round, which is the round that the SPAC investment came in through. So we were kind of partners on that, and been involved with the company since that time as board member, board observer. Lots of ups and downs along the way, but at the end of the day, this is a company that has a massive market opportunity that's ahead of them over the next decade and more. And so, it makes sense to have now done this transition to being a public company.
Cool, thank you so much. Can you talk just a little bit about what Pangea Ventures is and what your thesis is, what you focus on?
Sure. So we invest in hard tech companies leveraging material science, chemistry, biochemistry, and we're also impact investors. So companies, addressing climate, food, agriculture, health, that sort of thing.
Cool, thanks so very much. Angela, could you talk a little about your role in the process and what Portland Seed Fund is?
Hi, sure. Hi, everybody. I actually had two roles at the time related to ESS. Portland Seed Fund is Oregon's most active early and seed and pre-seed investor. Today we've done over 150 investments, but at the time we invested in ESS, we were the first private check. I also was fortunate enough to have a kind of a front row seat to the excellence that was busting out in ESS. At the time, I was their first landlord as director of the Portland State Business Accelerator. Definitely getting to see them day by day played a role in believing in the team and the company.
Cool, thank you so very much. Eric Peterson, could you introduce yourself and talk about your role with ESS and E8 Angels?
Absolutely. I've been an active investor up at Element 8 since 2010, co-led the due diligence into ESS for the E8 team. We came in along with Pangea and SAC. Been following them closely, have been active in the solar and energy storage space over the last 15 years, and had the pretty unique opportunity, thanks Craig. Craig reached out to me. I had retired about 18 months ago, and Craig reached out in January and asked me if I'd come sign on and help re-stand up the marketing group and support the SPAC, and have been actively engaged in working with Craig since January of this year through the great event last week in New York.
Either John is thinking very hard about what we just all presented, or he has, or his system has locked up, his speed is frozen. So I think what I'll do is probably take the controls here. John, are you hearing us? Okay, I get, oh, and Zoom says I'm now the host. So, here's what I'd like to do. I'd like to back around and start interviewing some of the panelists. Craig, one of our plan was to have you sort of a background, further background on ESS and the ESS history. And would you like to go ahead and do that?
Sure. You know, where do you want me to start? I mean,
well, let's start in 2014. I think I'm kind of curious, how did you recall kind of coming into the process of meeting folks like Angela, Eric, and others at E8, Andrew at Pangea, and of course myself at Seattle Angel Conference? What was the condition of the company, the status of the company, and what had you engaging and for early stage funding?
Oh, so if I'm going to talk about meeting Angela, I'll have to step back a little bit further than that. You know, we started in 2011. The technology really started out of our garage. And so Julie and I had set up test stands in the garage, and we were running batteries there. We were getting chemicals shipped to our garage, and at some point the FDA or the DEA decided that it was not appropriate for us to get large amounts of chemicals shipped to a residential address. And so we either had to shut down and stop getting chemicals shipped to do testing, or we needed to find a business location. So that's where we, started looking around the Portland area for where we can get, a wet lab or just a lab in general, so we can actually start up setting up our facility. That's where we ran across Angela at the Portland State Business Accelerator. And so, we met her and had to apply to get in. And luckily enough, we were wooed them over enough that we could actually get in there and get our first lab space, so we could actually start getting material shipped again to actually start testing batteries. Now, back then, we were actually working on a different battery chemistry. We were actually working on vanadium-based batteries, but quickly pivoted, I would say, in the 2012 type timeframe. And in 2012, we pivoted to the iron-based chemistry, and that's where we did a lot of the work with SAC and some of the earlier investors. We did get a lot of early money from folks at ONAMI, which is Oregon Nanosciences and Microtechnology Institute, as well as Oregon Best. We got money from them as well, but Oregon ONAMI was also some of the first money in. We got a big check from them, I think $250,000 to do some of the initial development that was still on our vanadium-based technology. But through that work with them is what we'd actually, decided we needed to pivot to a much lower cost chemistry in order to be competitive long-term, with chemistry such as lithium ion, as they were driving the cost down. So we had to be pretty nimble as the market was evolving, and we started to see it was actually going to become much larger than what we initially anticipated. And lithium ion was going to be a big player, so we needed to make sure we're going to be competitive with them. So 2012 pivoted to that, and then that really helped us kick off and get the grant from the Department of Energy, which was around $2.1 million, and that's what really helped catalyze the organization. But unfortunately, that money came with a cost share, which was 20%. That money also came, with we really weren't allowed to pay founders' salaries, and so still, Julie and I at that point were still working, without salary at that point. But it really allowed us to hire employees, and so ONAMI money, as well as getting into the PSBA and then the government grants, allowed us to start scaling the organization with employees. But with that came other expenses, and so then we needed to start panhandling for capital, and that's where we started doing a lot of that work with the angel funds, going around and flying all across the world to play in these competitions to try to raise capital to get to the companies to the point where we had a really good foundation on the technology, so we could actually create value and go to the venture capitalists and start getting some private money where the valuation was going to start getting set. Unfortunately, Andrew still got a great deal. I still feel like that should have been higher valuation, but it is what it is at this point.
Thanks for that background, Craig. So, on that note, I should have opened by saying just congratulations to you and the whole team at ESS for what's been happening over the course of this year and what just happened back on October 11th, which of course was your opportunity, you and the team ringing the opening bell on the New York Stock Exchange to go to now be a public company. How are you guys feeling, and how is the team feeling? I kind of wanted to open with that. What's your ride been like in recent weeks and over the course of the year?
Well, certainly riding up to the event was very, very exciting. I don't think most people knew what to expect. We're a pretty technology-oriented company, right? So everybody's pretty much heads down and working on science. So it's hard to get a lot of emotion out of engineers. But I think at the event, a lot of people were very exciting. It was whirlwind type stuff going on. It was very event packed, where we're just moving from event to location. So it was very exciting and fun and exciting. But everybody was back in the office on Tuesday and Wednesday, back to work. So it was just another fundraise for us.
Got it. Yeah. Well, that's. I hope you had some time to toast your success over there in New York. The pictures looked great, but really glad to hear you guys are back and focused, and that's really been reflected in the news that we've seen coming from ESS in recent weeks here. Clearly, the public news has been great, and in terms of what your customers and partners are responding, and I'm sure there's more ahead. So for the benefit of those of us, or for those here who maybe this is their first time even hearing about the term SPAC, can you give us sort of the short version of what really did ESS just come through? What's a SPAC? What did it mean to go public by SPAC, and what does it mean to de-SPAC?
Yeah, so in simple terms, a SPAC is essentially merging with a company that is already a SPAC, but the company you're merging to has no operations. They're just basically an empty shell that's floating around in the exchange, looking for somebody to come in and fill it and create operations. And so SPACs have been in the news a lot lately. They saw a lot of activity happening in 2020. And that's what really we started to see an opportunity for us to do a big value raise. And typically there's a couple different ways you can go public, right? You can do a direct listing, and then you can go the SPAC route. The challenge with a direct listing route is you typically need to have a lot of good operations behind you. You need to have good revenue so you can forecast out what the value of the company is going to be. The SPAC route tends to be more forward-looking, tends to be more of kind of like the way a venture capitalist may look at that organization. They're looking at the next 3 to 4 years out, and what the potential for the company is. And so it was a good fit for us, and it was also a good fit because it was a good timing in terms of the market was really at an inflection point where we started to see more and more long duration hitting the market. Our backlog was starting to grow very, very quickly. We needed to get capital so we could expand the organization. We had a couple different routes. We were already planning to go back to the private market and either do a mezzanine round or do some other financing round to get more capital in the organization, or we can go the SPAC route. And we had to look at which was going to be more effective for the organization, not only in short term but also long term. And the public market just looked very attractive given where the valuations were and what we could do with capital downstream with the organization. I don't know if I answered your question, but
yeah, absolutely. Thank you. Yeah, I hope that's useful to those here who this is all new to. I have to say, when I heard the SPAC news, back in the public announcement that ESS put out with Acon S2 about it back in the spring, I had never heard of a SPAC, or I just started hearing of them. So I'm sure I'm probably not the only one who's getting a rapid education on that this year.
It's certainly it's not an easy route to go. There is challenges associated with it. There's a lot more rigor involved, and it's a little more expensive than doing a direct listing as well. So if everybody thinks that going the SPAC route is an easy route to go public, it is not. There's a lot more involved in it than potentially just doing a direct listing. Direct listing, you just need to file an S1. During the SPAC route, you need to do an S4, which is basically the merger materials that go into that, and then you have to file your S1 or update your S1 later. So, and then you have to be public company ready, right? Because the company you're merging into does not have public company operations, and so you're taking over all the capital that the SPAC has, basically in their trust, plus the capital you're raising on the pipe. And with that, you need to have a finance organization that's able to do all the SEC filing requirements, have the legal requirements behind you, have the investor relations behind you ready, because the SPAC does not have that stuff set up. And so you really need to be ready to go public. So it's just not a merger into an organization that is ready to run a public company. You're basically running the public company.
Got it. Now I see one of our audience members has posted a question. What is a pipe?
Yeah, so there's two different ways that the SPAC gets capital. The first is the trust, and that's really the capital that the SPAC has raised. And so the SPAC go out when they do their initial public offering, they'll raise a bunch of money. A lot of times it's going to be around the $250 million raise, so $250 million. So that's one pot of money that the trust is trying to dispel to the target companies that they have available to use. And the other spot of money is once the merger announcement is out there, then you do a roadshow, which is almost traditional to a regular type IPO type route, where you go out there and you pitch the deal to investment banks, hedge funds, corporate sponsors, so on and so forth, and raise another bucket of money. And so when we did ours, our SPAC had $250 million in trust, and then we had $250 million in the pipe. And for us, we actually initially went out to raise a $150 million pipe, but because we had such large interest in the deal, we actually raised $250 million in the pipe. And that pipe was led by folks like Fidelity, Koch Industries, Van Eck, Tortoise. So we had some pretty good long-term holders in our pipe. Because frankly, you don't know what the trust is going to do. The trust can redeem their shares at the time of the merger. So that money is not a guarantee. The pipe money is a guarantee. And if you follow the news on our deal, we had around 83% redemptions on the trust, which means when the deal went through, the people that had the money in the trust took 83% of them took their money back. So we didn't get all that $250 million that we expected we were going to have.
Great, thanks for the explanation. I'd like to pull in now the early investor panelists that we have with us, from Andrew, Angela, and Eric. What I would love to do is kind of go around with each of you and say kind of this year, 2021, this spring, what was your reaction, or what was your response when you heard the public announcement about the going public by SPAC back in May? And then what did that trigger for you about thinking back to your original due diligence efforts back in 2014? And sort of, can you tell us, I'm going to ask each panelist to kind of describe what were the highlights, or how did you go about looking back? How did you know, or what were the factors that were influencing your decision to invest in ESS 7 years ago or more, when you first met the company. I'm going to start off with Angela, because I think, Angela, you, as you mentioned, I think we're among the earliest to engage with ESS.
Yeah, well, obviously, the news of a company's intent to go public is sort of music to any investor's ears. It's also news that we shouldn't get habituated to hearing very frequently. So this is our first IPO in our portfolio of 150 companies. We've been investing since 2010, 2010-11, when we really started Portland Seed Fund. So obviously I was excited, but a lot can go wrong on the way to an IPO, especially via the SPAC process. There's just a lot of things that have to go right. And I think an advantage for this team is that they started the process early, before SPACs got really frothy and interesting to people. These kinds of things often attract ne'er-do-well service providers, companies, and there's a shell or a pipe. And so I'll use the word shell game. It can be a big shell game. And you do see some of this frothiness now, a year later than when SPACs kind of became in people's vernacular. I think that by securing quality partners, we had more confidence in the ESS SPAC than we did in others that we were hearing about in the news in the same time period. So I'll just say that about the IPO part. About the early involvement part and connecting the dots there, I often think I have the best jobs in the world. I am essentially an investor and a talent scout. So from that privileged seat I had at the PSBA, Craig, I can remember you coming in and pitching us the investment committee of the PSB, or not the investment, I'm sorry, the admission committee, right? We were only bidding to be your future landlord. You were a smart and serious gentleman with a plan. We've heard a lot of crazy plans. But somehow we decided to break our own rule of only investing in teams, because at the time it was just you. Julia hadn't come over yet officially to the company. I don't know if you remember that. But we ended up with, well, what do we have to lose? We have rolling 6-month leases. If he can't pay the 6-month rent, it'll be done soon enough if he doesn't get that ARPA-E money, right? It was right at that brink. I don't know if you remember that, but that was the dialogue at the table about whether we should let you in. So we broke our own rule to let ESS in. And I think that's kind of an indicator of what we saw and continue to see at every stage. And then what other investors who could add more specific talent than our early investors, that what you add as an early investor is real different than what you need at a later stage. So I would just point to the brilliance and the work ethic of the team was really apparent. I could, at the PSBA, I could see their fob records, and they were in at all hours doing all kinds of stuff. At the time, there was sort of a friendly competition for lab space with 3 of the companies. The other one, by the way, has also gone public. That was Absci, one of the others. So that's kind of a fun story. But as an investor, it was a lot of fun for me looking back to have gone to my business partner, Jim Houston, at Portland Seed Fund, and say, Jim, I know we said we would never do clean tech, and I know it's only 25,000 we're going to put in, but we've got to do this deal. And
this fund that works here, by the way.
Yes, I am aware. Yes. And, Jim was able to be convinced, and we were happy to do the deal. I would also just say, though, there's an importance, and this is for all the Seattle angel investors. It's super important to know what your role is as an early stage investor. As Portland Seed Fund, we are sector agnostic. That means we're generalists. I would say we're stage experts. We are expert at sourcing early talent and knowing how to back it. And we've done it, we have a really great track record with exits and making money for our investors doing that. But that's pre-seed, seed, very early stage stuff. I am under no ruse that I'm going to add value to a deep science and technology company as it relates to the vast amounts of capital it's going to need to continue to grow and scale, the technical expertise, and the global industry introductions that are very specific. So I say that because sometimes I see angels trying to over optimize their role as company scale. And I just don't think it's in anyone's interest. So know your lane, know the value you provide. It's those early connections. It's that early capital when no one believes, and know when to get out and let others take over. I was really glad to see Andrew and Pangea get in and do a phenomenal job leading the company and staying with the company this long.
Great, thanks for that. And with since you mentioned Pangea, let's segue over to Andrew. What's Andrew? Can you go ahead and reintroduce yourself and remind us how you came to know about ESS and kind of the origin story looking back to 2014?
Yeah, great. And thanks for those comments, Angela. I appreciate that. So yeah, we'd followed the progress here for a couple of years, before we actually invested. I think, we actually provided the term sheet for the company kind of in the fall of 2014. And it was really a number of things. Craig had mentioned the ARPA-E government money that they'd received. We saw the great progress that they'd made with that. And so that showed us that we had a smart, scrappy team that was able to kind of get pretty far with little resources, compared to the other battery companies that we'd seen. So that was sort of this looks like it's an elegant technology, easier than others, and a great team behind it. The other kind of key ingredient in any kind of venture investment where you want to have an outcome, like I think this will eventually be as a company, is it has to be a huge market. And, there has to be sort of tailwinds behind it to kind of make things easier. And I think that was a thesis that we had all along from the early days, that, long duration storage was going to be a really important kind of cornerstone piece in decarbonizing the grid. And that, I would say, that thesis has held true. And I would say it even looks like it's going to be, bigger than we maybe anticipated. I just, earlier this week, I don't know if I can share my screen actually, saw this graph, if you guys can see that. And so this is like the energy supply that the IEA sees kind of over the next few decades. And you can see, batteries become, significantly bigger than oil, and also solar and wind. And so this is a massive market, and we're still seeing that we're kind of like the only real company that can supply at that sort of long duration period, which is probably the biggest chunk of that. So that's really promising for the next few years, I think. Yeah, is that helpful?
It is great. Is there any, we're going to come back around and talk a little bit more, looking back at the due diligence, sort of the, where we can go a little bit deeper on insights and then what's happened since. But before we do that, Eric, you're here from E8, and what was going on with the E8 investors? And we have several, I think, E8 investors who actually participated in your due diligence back then and became investors. Is that right?
I'm not sure who all from that group is on the call, but I think we came to very similar conclusions that Angela and others at the time had, and that really was, again, it's market, it's team, and I think really what was attractive was Craig, and at the time Julia then was in the business, but they really went about validating the technology in a really smart way. So much of that technology validation was already done, or well underway at the time of the Series A. I was I had come from the industry, knew the industry well, believed that the market was going to be significant. To Andrew's point, it's proven to be even much bigger than I think any of us back at the time thought it would be. And I think, back to the start of your question, I think it really, when I found out what Craig and the team were thinking about doing with the SPAC, it really was the right approach. As Craig said, right? The market was accelerating dramatically for storage. They had a technology that was proven and ready to scale. and they needed access to capital, and it really was the right approach. I'll throw out one more that hasn't been mentioned, and Craig and I have had this conversation many times, and I look back and say, if it wasn't for Craig's financial prudence and just oversight and discipline, I think we've all seen plenty of entrepreneurs and early stage companies go spend money on lots of things and enjoy being a founder and a CEO. Craig really held his powder. And I think part of the reason that this company has been such a success story is his just disciplined approach to where he'll spend money, spending the money on the technology, not wasting money on the early stages of marketing in a market that was still very early. I think that's really, for me as an investor and following the company through this whole process, really, I think it's potentially underrated, but I think it really is a huge testament to Craig and Julia's leadership and where they chose to spend money and win that allowed them to get to this point. I think it's really a pretty remarkable trait for a founder to have that discipline.
Yeah, here. Thanks for that additional background. I can echo, thinking back to the Seattle Angel Conference due diligence process that we were in fall of 2014. Many of the same kind of discoveries or determinations. In fact, John Seacrest, do you have that slide? I thought it would be fun. I went back and I dug up. We prepare in the SPAC process. We prepare each due diligence team. There's about 4 or 5 people on each performing due diligence on each of the 6 finalists. We do prepare a written report, but we don't publish those. What we do is we give a summary of our due diligence findings on stage at the Seattle Angel Conference event, the final event. So I went back and I pulled up our slide that was presented on stage. Craig, you may recall you had given your pitch, and then the due diligence team lead came up on stage with you and sort of summarized the nature of the due diligence that had been performed over the several weeks of the conference competition, and then you had the opportunity to comment on that. And I would say, I won't summarize all these bullets, but I think it's interesting to look back and sort of it was fun to remember that we did a interesting for as sort of quick as that due diligence is over a number of weeks, and for how new many of us were as angel investors at the time, like I know many of the audience here today are, we did a pretty robust due diligence. I recall phone interviews, the team doing phone interviews with Craig. I went back and recalled that there had been an interview with a battery expert. I don't know if that was one that had been referred by you, Craig, or not. But we had some insights in our report looking at the battery technology and battery trends. One of our due diligence team members who's on this call, I think Doug, went actually down and did an on-site visit, met with you, Craig, and Julian, the team. We had those on-site observations. And I'll tell you, as an angel investor, one of my favorite things and almost must-dos, which has been very challenged during the pandemic, is to meet the team, ideally in person, ideally at their site if they have one. It really gives you a sense of sort of how far along the company is and what the focus and passion of the entrepreneurs and their team is. So it was really amazing that we had the benefit of that. The other thing I want to mention that really supported our due diligence was our opportunity to speak with Andrew and Angela. Angela, I met you at an Angel Capital Association conference in the summer of 2014 that I think, Craig, you even delivered a presentation at. It was down in Portland. And although I didn't have the opportunity to meet Craig there, Angela, you and I met, and you said, "Hey, I got a company. I think you folks up in Seattle should talk to." And that's kind of what started the ball rolling for the introduction for ESS into the Seattle Angel Conference, and that's how we connected, Craig. And what my reflection there is that those connections that were made, right? We were kind of between Seattle to Portland through you, Angela, and talking to Andrew, and then finding the E8 connections. That was really provided some fabric for our due diligence discussion. And we were kind of, I won't say we were all in the same place because Seattle Angel Conference was coming up, so it was so new you guys brought us up to speed, but it really supported, I think, everybody's due diligence and strategizing in that fall of 2014. And we all were kind of talking about the same things in terms of the compelling market opportunity and how thoughtful Craig, you and the team and Julia were being on how you were going to approach these different opportunities and these different unknowns in this very early technology and a very kind of not clearly defined or clearly timed market. And where we left the due diligence, I think, in sort of with open questions, was that the focus of the company, we thought, focusing on the corporate governance and the team building, which is exactly what you went and did to bring on senior staff, and focusing on your marketing, sales, and business development. Really thinking about a lot of competitors and competing technologies, those surfaced in the due diligence. And Eric, as you were mentioning, sort of there was a very thoughtful, we witnessed a very thoughtful navigation of all of that in the subsequent years. And then just really asking the hard question, wow, this is a really long market potentially. At the time, I remember the energy prices that were dipping. And so there were some of our members were saying, hey, how fast will solar grow? How fast really will there be the need for long duration storage? And that factored into our thinking, well, can ESS survive that long? And what would it take for the company to be sustained through what could be a very long period of development and market development and technology development? So I kind of feel like we were all kind of looking at the right things back in 2014, and then really taking a bet that the team was really equipped to go in and navigate those. And here we are, sitting here 7 years later. So my question is, sort of, Craig, with that walk down memory lane, what was your experience of all that at the time, back in 2014? Were you finding it to be useful? Do you think we were asking the right questions? Or were we just kind of pestering you?
So it's a long time ago, so I have to think back. So I think always the due diligence activities with all the investors it's always worthwhile in that it asks the right questions. It's annoying at the time, to be frank. I mean, it's a distraction for an entrepreneur to have to raise money all the time. It seems like every time we got done raising a fund, we were getting ramped up to raise the next fund, because it always takes longer to raise your series round than you planned. And so it seems like just as you get done doing due diligence for one round, you're starting due diligence for the next round. But doing those events was always worthwhile, not only because it allowed us to answer all those questions, get them documented, but then also get up and present it in front of the group, right? And that entrepreneurs don't always do well in front of groups, and so getting that experience as you're growing the organization to get up and talk about that stuff is very important.
Got it. Yeah, we're obviously very glad you did. I mean, speaking for myself and what I witnessed in the Seattle Angel Conference, when you came and you presented, you were very patient with us and our questions, and you really had to distill some very complex market and technology matters down to help us as investors really understand it and see what the proper big picture was, and sort of why it makes sense to invest in something that is potentially so long term and could have different pivots, both technically and pivots in the market, pivots in the business strategy. And in the end, it sort of seems like you followed a relatively, sort of what the roadmap we were expressing.
Well, I mean, I think the market is still a big challenge for folks to understand, right? Not only for the angel investors, but as you get to the series investors, and then even the public market, right? Everybody understands EVs and electric cars. Everybody understands consumer electronics. The grid is a pretty abstract thing. You plug your hair dryer in, and all of a sudden everything just works, right? But the stuff behind the scenes is what's complicated. And understanding how everything works, that when you plug your hair dryer and turn your light switch on, thousands of miles away, a generator is ramping up to accommodate that load, and then to understand how batteries can facilitate to take that decentralization away and make it more centralized. It's not as easy to understand for everybody, and so that was a challenging part of the market, to get that messaging down. And the more you do it with different angel investors, the more you do with it on normal or series investors, the more you got the messaging down and understand more of a clear, crisp message.
We've had an interesting question from Rob Stevens in the chat, that looking back on the due diligence, and yeah, Rob, you're exactly right. I remember seeing this in the I think it was even mentioned on that slide and in our written report. This notion of a focus on the behind the meter system and the microgrids, and it seems like there was maybe some sort of pivot or deviation from that as you progressed in the subsequent years. Can you comment on that, Craig?
Yeah, so certainly when we were talking in 2014, there was really no market available for the front of the meter market, for the grid per se. Everybody was looking at short-term duration with frequency response, VAR support. That's really what the grid was focused on at that point. That's where lithium ion was, just fine. We focused on the behind the meter originally because that was going to be an easy entry point for us, because folks with solar on their roof or were looking to play tariffs, particularly down in California, doing energy arbitrage. There was a market for that, and you could actually prove the economics. I could easily take the tariffs down to California, and I could show that if you put solar on a building, you could easily pay back the system in 2 or 3 years. And so that was an easily distillable, economic model that I could provide to folks. It's more complex when you have to show the utility model, right? And there really wasn't one at that point, even though we knew one was going to be coming up with renewables dropping in price. It was hard to distill what the payback for the utilities was going to be, and whether utilities even want to adopt it. Certainly now that's even accelerated on the utility side more than we anticipated. You have this big ESG focus now. You have the wildfires that are really starting to ramp up, and climate change, which is causing problems. You can't use lithium ion in those zones. You can't use diesel gensets in those zones. Really, the only technology you can use is our technology, because it's non-flammable and non-toxic, which is well suited for these microgrids behind the meter, as well as the front of the meter. So the market's just expanded very quickly for us.
Excellent, excellent. I'm going to ask our panelists, Eric, Angela, and Andrew, are there any reflections that you have on sort of how you're as you watch the company, looking into 2015, post Series A's into 2015 and 2016, any reflections on the path that was followed, maybe the behind the meter thing or other aspects that you were thinking, oh wow, that is what we expected, or that's not what we expected when we made our investment?
Sure. Maybe I can start. It's Andrew here. I was pretty deeply involved with the company as a board member, so I think I kind of saw most of this, and I can say, looking back, we probably made a few mistakes. I would say though, that's sort of in a retrospect, I think all the decisions that the company made, at the time were the right ones. Sort of continuing that theme of being sort of scrappy that Eric talked about. I think that was really important through the journey. But within a year of that initial investment, I remember the company having discussions with groups that were interested in this product in different parts of the world, kind of obscure places, and the size of the opportunity was massive. Like $100 million kind of projects, if I remember correctly. We weren't anywhere near ready for that, but it was kind of a nice shiny object, that was kind of getting people excited. So that I think was positive, that there was this sort of market opportunity, ahead of us. But we just needed to kind of put heads down and focus on getting the technology to the readiness level that it actually needed to be to, support this market.
Super, thanks, Andrew. Eric or Angela, any reflections back that you want to comment on in terms of the sort of what happened immediately after the Series A, or watching the company ever since? And actually, what another question would be, what has been your group's in participation or involvement or communication with ESS since the original investment?
Go ahead, Angela.
Okay. So again, back to my comment about being an early investor that does not have sufficient capital to keep a capital hungry company like a battery storage company thriving, we shift to really what our roles are. Being a connector, a persistent connector, I think that is a really key skill set, right, for an early investor. I think how we would look for signs of success, like, did we invest in something that is being passed into the right hands? It's not just capital, but smart capital with dry powder. Are they getting investment from people who can stay in future rounds because we know they're going to be those? And then we would increasingly want to see, we would want to see initial institutional capital, which we did, and consistent, or, afterwards as well, institutional rounds led, in the stair-step way you want valuations to go. So the other side of the coin is you want to see customers of size interested. And I think the next phase, once we invested, and by the way, PSF does follow on investing. And so we invested every stage of the way along with the company, as long as we were allowed or able. There are times for early stage investors that things are going at such a pace that you don't get to invest anymore. And that shouldn't always be seen as a bad thing. It's kind of, I'm not sweating right now that I didn't get another $25,000 into the company. We're going to do quite well. So if you have big scale potential wins, you just have to follow that playbook. So the comfort we got, I think, from seeing a variety of institutions from a variety of perspectives interested, I think of BASF. I also think of Wells Fargo and National Renewable Energy Labs early on, providing some sort of third-party validation. That was very early. That kind of stuff is comforting for an early investor like me. As things progressed, the investors got bigger, more sophisticated, and the customers did as well. Again, there's just a moment where you just sit back and, it's like being a kindergarten teacher. You don't want the kindergartner pulling at your pant leg all through the journey, but proud kindergarten teachers looking at where their kids land, right? That's kind of the motto, I think, that I think about. And that means, just like kids, who has adult kids? Just show of hands. You never call, you never write. There can be a little bit of lack of communication to small investors or early investors by companies as they scale. Some of that is for good reason, and other times I think scaling companies could do a better job of that. I'm not going to be too easy on Craig here. I'm going to give him a 5 out of 10. It's okay. He's a scientist. He can take it. He wouldn't like it if I glossed over it, right, Craig?
You're welcome.
So those are just some of my insights. But again, partly I'm tuning my comments to all the early stage investors on this call. What is legitimate and appropriate for you to expect at different stages? And hopefully we all can agree that playbook does not prevent your win from being glorious if done right.
Well said, Angela. Yeah, very, very interesting way of thinking about it. It's when we were in Seattle Angel Conference, many of us are, especially being new angel investors, we're barely just figuring out sort of how to ask the right questions and what is our capacity to even analyze at that stage, to even think about what's comes between the investment and hopefully future exit, let alone the exit down the road. There's a lot to process. And, being an angel investor, learning to be an angel investor is clearly it comes with time, and it's definitely a process. And that's one of the reasons we wanted to get this group here together today, is because we're all going through that process together. Some of us with more experience than others. You guys have a lot. Eric, speaking of experience, what was yours or your view individually or from for the E8 group in terms of what the road has been like, between the original investment and this year?
I'm telling other managers right.
I'm not sure I have a really brilliant answer, but I think Angela's got me excited about becoming a kindergarten teacher in my next career. But I wanted to point out really quick, just because Angela hasn't said it. I don't think we have a picture from the due diligence of the original. I think, Craig, what was it? A 300 square foot lab. And you can see behind Craig the fully automated robotic assembly of a 300,000 square foot facility that is actually being expanded right now as a result of all of this. So I think it just again speaks to it's really a dynamic process, and we said it a little bit earlier. I'll echo it. I think way back we shared notes between the Eliminate due diligence team. Angela, we talked with you. We talked with a number of the technical folks at ARPA and other experts. We talked with the SAC team. I think it really is part of, and I think a number of us have stayed in touch. Andrew and I met through this whole process and have stayed in touch and talked about interesting markets and opportunities. I think it really is, it is very much a collaborative process amongst the early stage investors. I got busy with my own company after the Series A was around, chatted with Craig and some of the others. So I can't speak as much to the engagement, but I'd love to hear Craig say a bit more just about the thought process of coming off the Series A, and then Angela mentioned BSF with Cycle, and then the big dogs with SoftBank and Breakthrough. Just how he thought about as the founder, chief fundraiser, how he grew out of that Series A early stage mindset and started to look for the next round of investors, what was going through his head, what he learned from that process. But
yeah, that's fine. So I will say I had no idea what I was doing for the Series A, and so a lot of the support and everything came from Andrew and the Pangea team to help lead what's the best way to go. And so a lot of that stuff moving from Series A to Series B, that really came from the Pangea team, really driving us to get more folks like BASF and more corporates involved to help scale the organization, as opposed to staying down the venture route. And I think as we got into our Series C, we started to get more and more. So we have our Series B, we brought in BASF as the main corporate, and we look at our Series C. We have SoftBank Energy, we have PTTGC, we have Evergy, which is part of Kansas City Power and Light. And so as we grew as an organization, we got less and less venture capitalists involved and more strategics. And we got those strategics involved because they would have some fit in how they would help us grow the organization, either by using supply chain or deploying product in the field. And that would add credibility to the organization as well. And so no mastermind here other than Andrew and the team over there in the early years guiding the organization on what's the best way to do this stuff. But one of the bigger successes I would say is really, and Eric kind of mentioned this, it's all going to be around being frugal with your capital. We spent, between the time we started the company in 2011 to the time we went public, we raised less than $50 million. When we announced the SPAC, we did a bridge to get some additional capital, and that brought us over the $50 million point. But the fact that we were able to develop a brand new technology, battery technology, get commercial customers, and build up a semi-automated production facility with less than $50 million, I think that's what really made us successful, besides the technology working and other things. But that was, for us to keep valuation going and things like that, that was part of the success.
Great. Thanks for updating us. I was definitely, and thanks Eric for asking that, because I definitely wanted to hear and have the audience hear a little bit about sort of what happened, right? And what's the path like that ultimately we're kind of driving to sort of understanding what are the implications of going public now. And we've had some questions in the chat room that we should probably pull in now. I'm going to invite anyone who has some questions to either raise your hand or chat in the chat room. I want to be mindful of our time now. We're about 1:15 now. But some of the questions I'm seeing in the chat have to do with, and you touched on the SPAC process and a little bit earlier at the top of the session, Craig. But can you elaborate a little bit more in trying to find the question? Can you speak more to the SPAC? How did Acon S2 find you, and then what, or did you find them? Like how did it come together, and why did it come together at this time?
Yeah, so I would say the way that the SPAC evolved inside ESS is what we were starting to look at what we're going to do for funding to help scale the organization. So talked with Andrew. Andrew was an observer at that time. He wasn't on the board anymore, but he was an observer, as well as talking to some of the board members. But Andrew and I actually were the ones that had a pretty in-depth conversation around what's the best way to move forward on funding the organization. We can go the private route, or we can look at the public route. And there's the going the SPAC route is certainly an inexpensive way to do it. And that's what, being frugal, I wasn't very excited about the SPAC route because it's more expensive. Right, you can do a direct listing for around 7% of capital. The SPAC route can cost up to 20%, and then and you get good valuations. But then you can also do the private route, which your valuations may not be as good. You may not be able to raise as much money. And so I was a little hesitant with the SPAC route. It took quite a bit of research and quite a bit of modeling to convince that may be a good opportunity to go down. There's a lot of resources out there in terms of finding a SPAC, right? You can get newsletters. I think Alpha SPAC is one that I kind of subscribe to, and it goes into detail on a lot of SPACs that are out there looking for targets. A lot of SPACs that are in process, some getting ready for IPO, some that have already completed their deal. But if you're interested in doing a SPAC, I would recommend that you start looking at that stuff, understanding what the warrants are, understanding the sponsor promote. And there's a lot of recommendations. If anybody has questions on that, certainly feel free to contact me, and I will give you my two thoughts on some of the deal terms. But I kind of lost my train of thought. But maybe ask the question again. I went down some tangent.
Oh, you got it. You basically were just in terms of you're addressing the thought process that went into this, to choosing to go by SPAC, to go public by SPAC, kind of at this time. Yeah. And then what are some of the implications of that on the governance of the company, and how your board evolved, and how does the board oversight, how does that change now, having gone public in this way, and how is it different because you went by SPAC or versus IPO? Do you have the same governance for the most part?
So if you're talking about the board always evolves, right? So the board is going to evolve every series round we do. Every time a new investor comes on, they're going to want a board seat, and you try to keep that board as balanced as possible. And so some investors come on, some investors they leave, they'll stay an observer. But the public, I would say, doing the public board changes quite more substantially, and there's less. It's very different than a private company board. The board certainly has less, I would say, control over how the company operates, and more advisory type role as a public company. But you have to get more strict on your governance when you're a public company, right? You got to have an audit committee. You got to have a committee member that's leading that committee, that's very experienced in SEC filings, doing audits with the Big Four, things like that. So if you just saw in the press, we just announced that we just brought on a new board member. So she's going to be coming on to help us, and she's going to be the audit lead, so dealing with all the SEC and all of our audits for our financials. You also then have the chairman of the board typically stays the same, but then you have compensation committees that look at how they're going to structure stock for the employees, how you're going to structure comp for the executive management team. And then there's the governance committees in general, just setting up the boards and how the organization should operate internally. So the board certainly will evolve, and it gets more structured as you become a public company. But internally inside the organization, it also gets way more structured, particularly I would say on the finance side of the house. We have to look more carefully at how we're doing RevRec, particularly when looking at and reporting on a pro forma versus non-pro forma basis. You have to look at getting SEC filings, and every time you do a press release, and Rev D type filings. So I got to be very careful about what I say here today, otherwise I'll end up in an orange jumpsuit, right? So it's being very careful with things like that. Certainly makes the company more strict and more put more rigor in everything we do. it's certainly our expenses go up quite substantially on the admin side because you just have to build out that foundation in the organization. So when we decided to do the SPAC, I think we actually met Acon, who was our SPAC sponsor, I would say in the September of 2020 type time frame. So the process took quite a bit, almost a year to complete the whole deal. So we started the first introduction with the SPAC in September of 2020. And then I'm not sure if that's actually what met Acon, but we actually started talking to SPACs in September. And then, you know, you do due diligence activities just like you would with a Series A type person. But then you get into the merger agreements and signing the deal structure, and that's where a lot of the terms come into place and how the sponsor makes money, what's the valuation of the company going to be. Once that's signed, that's when everything really kicks off. That's when you really have to start building out your organization because you need to file the S4. You have to have audited financials from a reputable firm. You need to have a really good law firm on your side. So, you know, Wilson Sonsini's was our deal firm there. And, you know, we spent a lot of time on our financials. And, you know, I think that the finance team is very excited because when we filed our S4, we had no comments from the SEC on our financials. Everything was extremely clean. So they did a fantastic job. But that document alone was over 900 pages, right? So spending the time to put that document together for the SEC took a ton of time, a lot of resources to get that done. So building up the organization is going to be, it's a huge thing that I don't think we initially expected would be part of the SPAC. It's just how much the organization had to grow just on the supporting structure to be a public company.
Great background. Thank you. Yeah, I mean, I think we're getting some questions in the chat room. They're sort of like any hindsight or regrets or like things, learnings, if you had to do it again, or if you were advising some of the folks in our audience, if they were in your shoes or going to be in your shoes, how would that they should pay attention to? Yeah, so I think one of the couple of things on the deal terms, probably the biggest one I think was the sponsor promote. I think if we were to do it differently, we would have tied that to the redemptions. So the sponsor wouldn't have received all their full promote with high redemptions. I think that would have put more incentive on the SPAC to not have as many redemptions as possible. If that was, if I had any regrets in the deal term that I had, it would have been not seeing that vision in terms of having to protect the promote. But at the time when we signed that deal, the redemptions you were seeing in the market were small. They were 5, 10, 15%. So it wasn't something that we were seeing like we're seeing today. Today, 80% redemptions is almost an everyday occurrence in the SPAC market. So if unfortunately I didn't have that foresight, that would have been one deal term I would have added. But in terms of going public, no, I don't have any regrets in doing that. I think it's been great for the company. It gives us the capital to scale. It's hard to compete with lithium ion and all the capital they have behind it, all the different corporates they have behind pushing lithium ion. We now have capital in the bank to actually scale the organization and meet our pipeline. We couldn't have done it otherwise. Yeah, I have to say, I mean, as I referenced earlier, I think a lot of people can relate to this. I was unfamiliar with this back in the spring when you announced it. There was some bad press for the concept generally and some speculation about SEC oversight and of the SPAC model generally, not specific to this particular SPAC. But over the course of the summer and watching your presentations from the company and reading more about it, I've become more comfortable with the process and actually even liking the extent to which some of the things you just covered in terms of what it's brought to adding information, adding insight, sort of bringing vetting into the whole process, especially the pipe, having the strategic investors and the additional funds. I was going to ask Andrew and Eric and Angela if you had had any sort of similar reflections over the course of the year in terms of how it's played out, how it's what kind of questions you're getting from your group members, and then just what your expectations are for the next 6 months, as investors watching this process play out. Andrew or Angela?
Sorry, I was on mute. Yeah, I could maybe start here. It was early summer 2020 when Craig and I first had the conversation about the SPACs, and the thought process I think at the time was, first of all, like it would be great to have that capital to really scale and compete with lithium ion. We kind of need that. In the back of my head, I had kind of the idea that, the public markets would be pretty receptive to this. There's really a lack of sort of pure play investment opportunities going after decarbonization, these days. And if you look at sort of millennials, like they really want to invest in this sort of thing, and the people like the big money managers, they see that. And so, I kind of had a hunch that this would be pretty well received. If we look at, there's a question in the chat about sort of the stock price going into the SPAC. I think Craig could comment on this, but I think what he would say is, I think all SPACs were kind of out of favor, a few weeks ago, and especially going into a closing and with the redemption, this is probably not expected. But, then when we look to last week, when this was actually trading as gigawatt hour, it's not a SPAC anymore. It's a public company on the New York Stock Exchange. It's been very well received in the marketplace. And so I think that's just a testament to, public company, the public markets are hungry for this kind of opportunity. And, it's been a lot of work for the team, especially the finance team, to get to this point. I think at one point it was mentioned the team hadn't taken, any time off, including, the weekends for, several months, 100-hour weeks, these kind of things. So we can thank them for that. But now that's behind them. They have the resources to kind of bring on the people they need. And, if this company needs to raise money again, in the future, it's going to be a lot less dilution. And, you can raise money as a public company in a couple of days, not months like it would in a traditional large private round. So I think this is a good thing, sort of longer term.
Thanks, Andrew. Eric or Angela, any comments on that particular topic before we go to maybe some other questions in the room?
Go ahead, Angela.
Thanks, Eric. Yeah, I think for us, because we are a fund, much like SAC, right? We're representing our LPs. And I think part of our job as investor of their money is to understand the risks and communicate and message expectations. So there is a 180-day lockup. We are in the universe where we have zero control over what happens. It's in the public market. I'm sure many of us like to check the stock price from time to time. But the reality is it's probably not going to be something like things not going well at the company that would affect the share price as much as investor sentiment. What are the broader hits on the US market? How's the market handling inflation? And what actually comes down with the infrastructure bill, okay? So setting expectation, we've all done extremely well. We can't do anything with that for 180 days. And we are down to things that we largely cannot control. That's it.
I don't have anything else to add, other than I think, Angela, you hit on a couple of key things, and that really for me is the timing for this. I don't know that it could have been any better. I mean, we could probably spend a couple of hours with Craig talking about all the things he learned and working with the bankers, working with the lawyers, perfecting the message, the investment thesis. But as we're standing at the edge of hopefully an infrastructure bill, and hopefully, I mean, we're walking into COP26 here the first week of November. All eyes are on what we have to go do around climate, around renewables. Andrew showed the chart. A huge chunk of that is storage. The market only gets better, and really the market is moving very quickly to embrace long duration storage. Short duration is interesting. It solves lots of problems on the grid, but it's short duration, and really now paired with renewables and addressing so much of the need to decarbonize the grid, decarbonize transportation. The opportunity for ESS is enormous, and I think the future is super bright, and that excites me as an early investor as I think about, what do I do in 180 days? And I've heard similar questions of me as I've talked to some of the other Element 8 investors So.
Yeah, absolutely, absolutely. It's we're definitely on an interesting ride. It's an interesting ride anytime you have an exit, right? As an angel investor, and it's IPOs and we're going public is an extra special one. I'm guessing this is my first, but from what I've read, and some of you, and I know some of you have been through this before. Krista has been waiting patiently with hand raised. So I want to, and I know we're kind of down. We're going to lose maybe some of our panelists here at the bottom of the hour. So Krista, do you want to ask your question?
Yes, thank you. I'm just thinking about becoming an investor, and I was wondering if you could tell me how I could do that. With my background in nursing, I kind of want to make sure that as I move forward, I do something that's not only worthwhile, but that, you know, when I get involved, I can, you know, get involved on a level that is really lucrative. Can you explain that process?
That sounds like a great question for John Seacrest.
All right, thank you. Well, so the Angel Conference is a sector agnostic investment thing where we all hold hands together, sing Kumbaya, and do the experience as a group to try and understand how the process works. As a nurse, you might care more about the APIS Health Angels program, which is coming up in January through March, which Elizabeth, who's on the call, is the program manager for. They're the same model. The difference is that APIS is focused on health-focused companies, where SAC has no sector bias at all. Both of them are very early pre-seed stuff. So I'll put my LinkedIn into the chat, and you can connect to me, and I'm glad to talk offline about the details of that. Probably this is a good time to talk about the next event, just so that we get it before people get out of here.
Thank you. I appreciate that.
So our next event is November 17th. That we picked the semifinal or the finalists last week. We did the due diligence first meeting this week. We'll do a couple more weeks of due diligence, and then on the 17th, we'll all get in a room, hear all 6 of the finalists present, and then the investors will go back in the back room and fight it out and pick which company they're going to make an investment in, right? And so we'll invest $200,000 in one of the 6 finalists on the 17th. And you can find that at the Angel Conference.
So I can attend it? Is it for
Yeah.
anybody to attend?
Yeah, it's public. It's public. Yeah.
And is it online?
It is.
Okay.
And in fact, we have a YouTube channel that has all of our workshops on it for the last year and some, and it also includes a couple of our previous versions of the Angel Conference. So you can look there for, and I just put that into the chat.
Okay. Can you tell me what time it starts by chance?
3 o'clock.
Oh, great. Thank you.
Well, thanks for
I'm
that.
going to be working in the downtown area on 15th Street. So that's why I was asking, because I enjoy going downtown, and I'm helping a colleague of mine out where there's a shortage. So that's what I do.
Well, thanks for that question, Krista. We definitely wanted to get the information out there for what's going on with the Seattle Angel Conference, and hopefully I'm guessing we might have some other people here listening to us today who have similar questions to yours, and between John and Elizabeth who have commented in the chat with some links, that they would be the right people to direct kind of background questions, right? Is angel investing right for you, and what's the best way to get involved with it? I'm of course I'm a proponent of Seattle Angel Conference as a great way to come on board and learn about it. And we had people come through it and become long-term angel investors. Some of them are on this call, and we have some who come through and say, yeah, I'm going to go invest in and engage in other ways in the startup community and elsewhere. But so thanks for that question. I think we're getting to a point where we should probably wrap up on looking more towards if any of our panelists, and Craig, if you can stay for a few more minutes, just in terms of the future for right? The company is public, and I want to reiterate that, Andrew, you mentioned, you said gigawatt hour. That was a reference to the New York Stock Exchange ticker symbol for ESS is GWH. I think that's really cool, and really reminds us of what the power of this technology is and what it's for. But what is really, where should all of us, as whether we're technologists or investors or entrepreneurs in clean energy, what is the next 1 to 5 years like, whether it's long duration storage or it's the type of things, the type of clean energy that long duration storage is going to get paired with? What are we all looking for? Where are the opportunities and trends that we should be mindful of? Craig, are you with us and able to comment maybe to kick us off?
I mean, I'm with you, but I'm going to be biased, right? So it's going to be long duration storage that's low cost. It has an ESG footprint, but other than that, I'm pretty mired in this. I would defer to Andrew and folks who get more visibility on other stuff out there. But the grid is certainly something that's going to be taxed here in the near term as well as the long term.
So Brian Gruckmeyer says that Elon's company is putting a storage factory together with 40 gigawatt hours of annual capacity. That seems like a low number to me, but how does that fit within what you're talking about engaging with?
Well, a lot of the stuff that Elon's doing is for transportation. So even if they do their LFP cells, they're going to be focused on transportation. The grid is typically where they would, when they don't have, or they have extra capacity for batteries, that's what they kind of push over to there. But their big money maker is going to be on the grids, on the transportation side. I mean, they're certainly doing grid storage as well, but they're going to be capped out around 4 hours in terms of what traditional applications they're going to be going after. So you don't see a lot of, 8-hour durations using lithium-ion type technology.
And those are fundamentally different markets in your mind. So
yeah, and the way we've always advertised it is that they're going to be useful up to around the 4-hour type mark, and so they're going to be good around a lot of grid services. The benefit with our technology is we can do those long duration applications such as bulk shifting, but our technology is also fast ramping enough where we can also play in the ancillary market as well, the grid services. And so once our assets are installed, we can take that market share away from lithium ion. So we have multiple benefits there, where lithium ion can't get into our space.
Right.
I would just also add, there's been just a huge number of capacity and factory announcements for lithium-ion batteries kind of around the world, especially the last few months. The question I have in my mind is, where are all the materials going to come from to support that? It's really hard to believe. And so, the best use for these batteries is EV or, cell phones. And so that gives ESS the opportunity to kind of be, really like the only provider in grid. But to get to the question about, other areas, I mean, there's just a huge variety of different areas to invest in to kind of address, climate. Definitely grid storage is one of the biggest ones. So, I would just encourage, and the encouraging thing about this go public transaction with ESS is I think finally, after many years, it sort of demonstrates there's a way for early stage venture funded or angel funded companies to really source the capital they need to really scale. That was not available 10 years ago, and it wasn't available certainly when we closed the Series A round, and it now finally is. So I think that should give maybe the people here the confidence that if they do find a company that's working in a big market, assuming they back the right team like we have here at ESS, then that capital will be available to help that company grow and eventually result in a liquidity event.
Thanks, Aaron. And Andrew, Angela, what about Portland Seed Fund? What is your outlook or hopes and dreams or for clean energy in the pipeline for your future deal flow?
Yeah, that's just a great question. We are kicking off the raise for Fund 4, January most likely, and we're likely to stick with our strategy of being sector agnostic, capital efficient with high growth potential investors, always aiming to get into deeper science and technology, very, of course, interested in climate. For us, that means making sure there are partners on the ground with, non-dilutive investment, people, institutions like our own Virtue Labs, I'm sure Element 8, ARPA-E, who are providing that sort of good housekeeping seal of approval on the tech, which we will never do a deep dive on the tech of a deep science and tech company. It's just not our expertise or what we do, right? So we aim to get into more of those, but again, it'll be through collaboration and building the ecosystem. So we have seen some really interesting trends. We did some other climate tech investments in Fund 2 and 3. They're also doing well. One is Onboard Dynamics, just to name one. Very different company. So expect us to continue to do these, find these, and follow the very early stage grant activity, and pick a few favorites and get in early. So you can look to us to continue to do that.
And we'll keep
Angela,
watching.
in general, do you have many Seattle investors coming into the Portland Seed Fund?
Yeah, we do. We actually have a fairly significant number of investors that are in, especially Fund 3, but also some in Fund 2. And we actually have a couple of angel groups as well. And so John and I go back to 2008 and 9. That's how we met at Oregon Angel Fund. We talk a lot about deal flow, deal sharing. And again, I think as an early investor, as an angel, it's important to hitch your wagon to people who have networks, because that's how you're going to get into good deal flow when you're not offering huge checks. Okay, so John and Keith, E8, they all are good networkers. We are also well connected, not just in the Northwest, but nationally. So yeah, there's a lot of opportunities for angels to expand their limited dollars and networks through things like SPAC and Portland Seed Fund for sure.
Absolutely, absolutely. Well said again. And we can round out. Eric, if you have any perspectives, you can have our last word from the investor panel side of things in terms of E8's view on. I mean, E8 is a clean energy investment group and fund. What would any final thoughts on the futures there?
I guess my final thoughts are we have lots of work to go do. There's lots of great entrepreneurs. We only have one planet. We've got a lot of challenges. I'm particularly excited in rural electrification. I think there's just remarkable opportunities for smaller scale electrification that are going to have lots of climate impact. But I think maybe the last comment, and others maybe want to chime in as well. I think the beauty of this early stage ecosystem, Ben Venture Conference is going on today. You've got the Portland Seed Fund. You've got other funds. You have Element 8, which has a fund as well, but also allows you as a what I was really attracted in 2010 when I first joined them was you get to learn from really experienced investors through the diligence process. You can invest in a fund and participate at that level. You can also participate as a part of a group and get access to the incredible deal flow that these groups generate. And write your own checks. So there's really so many ways to engage in this really vibrant ecosystem through groups. There's just, I think, certainly I don't have any interest in going it alone. I think there's just so much information that you gain by being a part of a group of people with a common purpose. And the collaboration really across the Northwest, I think, is super exciting, just from a culture, the kinds of companies we all think about, just our personalities here. So I think it's a great time to be in the Northwest and to be interested in early stage investing.
Thanks, Eric. Yeah, and it's I said you'll have the last word, but I guess I'm going to say that I completely concur. My experience, especially in SAC, in sea change, but in specifically around the last 7 years, on everything we talked about today, it has represented, irrespective of the financial side of it, the experience of having met you, Craig, and I'm very grateful for the time you drove up to Seattle 4 times to pitch and participate in the conference, and I'm sure many more times for that to meet with E8 and others. And the really rewarding part of this, the educational part of it, has really been what we're continuing to do in this conversation today, and what I'm sure we will be continuing to do over the next 6 months and beyond, by helping each other find the opportunities, whether it's coming from the entrepreneurial side or coming from the investor side. And I want to say thank you, John Seacrest, for the work you do, leading the Seattle Angel Conference and workshops like this that really are what create that fabric and those connections that enable this type of ecosystem to develop. It's going to have, with the work and the leadership and the products, technology that ESS is delivering, and all the other ESSs that are going to be enabled by the startup ecosystem, and this type of connecting and this type of educating and support, that gives us some hope on solving the big problem of climate change. So with that, I really want to thank again you, Craig Evans from ESS, for your joining today, and Angela Jackson from Portland Seed Fund, Andrew from Pangea, and Eric from E8. Thank you for your time. We did some behind the scenes preparation, as people might surmise. So thank you for your time in all of that. I think we'll wrap up the formal portion of this here. Anyone's welcome. I know some of you have probably stayed late, so we'll just say thank you. And I'll hang out, maybe John, you'll hang out if you want to, and we can chit chat more. I know there's sort of a networking and mingling portion of these too sometimes.
Yep, thanks so much. If you go to the bottom of your chat, there are 3 little dots. If you click on that, you can save the chat, and there's a bunch of resources in there if you like.
Okay, thank you, everybody. Thank you, Craig. And everyone's feel free to drop now, and I'll hang out here, and we can chat or chat in the camera or the chat if that's the plan. I'd love to hear from some of the folks who've been here listening, who are from the original staff. Yeah. How do you normally run this, John?
Well, yeah, go ahead, Rob.
Yeah, I was curious, now that it's gone public, I'm curious how we actually get shares. Are things going to happen that in 180 days that our LLC investment will turn into shares that will get allotted back to us? How does that happen?
Well, I should probably take that, given I'm the fund manager. We are speaking now just for SAC 6. We don't know the exact details or timing. My expectation, I believe the way this works is we don't see shares until the end of the lockup period. But our Seattle Angel, I'm actually the fund organizer. As you may recall, SAC 6, we used a third party, technically an SVP vehicle management company called Assure out of Salt Lake. So they actually are the front line who we'll be working with, and will be the front line to ESS on the distribution of the shares. So I'm not exactly sure. It's also sort of it doesn't matter for the duration of the lockup, really, for now. We are specifically not saying we have exited or are we in the process of exiting. We are in the process of going public, basically, of seeing our shares go from private shares to public shares. And the promise of the company may be that we all have the wind up with the option to retain our shares and remain shareholders in GWH, right? And right now it looks like there might be plenty of incentive for us to continue doing that. But my goal is to what I would love to do is, at the time that we do receive the shares through Assure, that we're getting those shares. Ideally, I would like the shares to be distributed to the individual investors, so everyone has the autonomy to make their own decision. What I have to figure out is what the mechanics of that look like in terms of brokerages and things like that. I have a question into ESS investor relations, if we can, to find out sort of, hey, can you give us some details now that you guys are kind of operating publicly on New York Stock Exchange? What does that really mean for us, or initial investors who were private shareholders? We have a 400-page doc that's in legalese, but I would love, I think we'd appreciate some help understanding sort of, okay, what are the deadlines and milestones and processes we should be expecting between now and the spring?
Any insights on that, Craig?
You're on mute, Craig.
I was the first to do it. So Keith will be receiving a letter in the mail, or Assured will be. I'm not sure which way the letter will go, but typically all of our stuff, all the common stock is held from Computer Shares. Computer Shares will be sending out notifications on how to access the common stock, which is publicly tradable, and you can transfer it to any location you want to, any brokerage firm at that point. But Computer Shares is the registered agent of the common stock, and that'll be the place where they get pulled from and pushed to wherever you want them to go. So for employees, for example, Computer Share holds those stock, employees will be able to pull that stock out, or other investors will be able to pull that stock out and put it to their brokerage account. I don't know how that works in your fund, but I'm sure Assured will deal with that. But if you have questions, Keith, I certainly go through the investor link on the ESS website. Feel free to bug Amir too.
Okay, we might be doing that. It's I think we're wanting to be super assertive. We're super excited about the process. We know we needed to give you guys the space to sort of execute and make it happen, which you did in spades in terms of a successful outcome last Monday, the initial publicly trading on the New York Stock Exchange. So now we're waiting with bated breath to kind of understand. We don't want to count our chickens before they're hatched, but I would love to be able to give our investors sort of like Rob and others, what's it look like in terms of when will we see shares, and more importantly, when are the decision points, if there are going to be any decision points. So I will definitely be following up with investor relations and your CFO. I appreciate it. Yeah, I didn't mean to put you on the spot with having to answer the tactics question here.
Certainly nothing you can do, and it doesn't matter until the lockup period's over.
That's what I've been inferring. Thanks for affirming that. Yeah, and clarifying. Yeah.
You can just refresh your Yahoo Finance account as often as you like.
Yeah, exactly. But who else do we have among us? Do we have any other of the original SPAC 6 investors? Milton, you're out there. I'm trying to, but it was a good showing today.
Yep, original investor here. Hey.
Oh, there you are, Kathy. Great. Yeah, I'm really glad to see so many of you participating. What was your, Kathy? When did you hear about did you learn about it from my email in the spring out to the investors? Oh, now you're muted.
Yep, no, there I am. So I did, that was when I first saw it. And I had been somewhat familiar with SPACs because one of my sons had worked for Rover, and it was he's now with Amazon, but it was going to be going public via SPAC. So I looked into what SPACs were about prior to that. So yeah, very exciting. And just so nice to, go on the ESS site periodically and just see all of the traction they're getting and all of the success. It really, really nice, really nice. Really happy for them, for you, Craig.
Was SPAC
Kathy Wachenko?
Oh, go ahead.
I just wondered, is Kathy Wachenko?
No, Kathleen McKenna.
Okay.
Yeah.
And this, I think, was SPAC 6 your first, I think, Kathy?
Yeah, SPAC 6 was my first, so that was a very fortunate set of timing there. And then since then, I've done a little bit with Sea Change, but I'm now kind of re-energized, wondering whether I should go back and do a SPAC one, because it's much more, it's much more, I don't want to say hands-on, but it's more, you're closer to the decision I don't know, there's something very, very extremely collaborative feeling about the whole SAC environment.
Yeah, absolutely. And as you mentioned when you were speaking during the session, that you were, or at your introduction, that you actually participated on a different due diligence. And that was interesting to look back on. I went back and I looked at all of the finalists from SAC 6. And I think ESS is the only one still standing. No, I think maybe there's one or two that are kind of operating, but sort of in a sort of not a growth mode, right? A lifestyle business mode.
Right.
But ESS was clearly, I think, of our finalists in hindsight, became the clear standout, survivor and grower. Some of the companies continued for several years and maybe even received some additional investment. But to your point about how collaborative it was, I mean, SAC is structured as a competition, but it's a very good-natured competition, and we're really using it to compare and contrast. And what was interesting is as I remember, the two companies, ESS and sort of the other one that had the investor, a group of investors really supportive of it after the due diligence, they were both really very much about big impact on the world and big impact on the planet. And I thought it was great to see that not that the other companies, were not that, but just that we had the opportunity to see different approaches to how investor money and angel money can participate in something that could be very, very, very significant for impact on social change and environment.
Yeah, the other one was Pota Vida.
Yeah.
They were the ones that had the bag that through UV would, and it had a little monitor on it so that it could be sent to third world countries and have people be able to sanitize the water that they gather for drinking. And it had a really good intention, stayed in business for a couple of years, and then couldn't get traction.
Yeah, what was interesting about it, that and the other companies is, I think we were looking, when we were in the final analysis, we were looking at ESS and thinking, wow, really compelling, but it's going to be so long, right? It's like but it has solar and wind and clean energy has to happen, and right now energy prices are looking kind of low, and they have to build these big batteries. This is probably ESS builds, I think, the largest thing that I've ever seen a startup what I've seen come through build, right?
Yeah. Oh yeah, they're 40-foot containers, right?
And so, we see so many, compared to software as a service, SaaS, or widgets or fashion or cosmetics or something, totally different thing to have to think about and learn. Thinking, wow, how does that scale? And so we were looking at ESS and going, wow, we love the idea, we love the team and the technology, but wow, can we wait that long? And some of these at Pota Vida and others were definitely more like, wow, they're gonna live or die. We'll know in the next 6 to 12 months.
Yeah.
If that's gonna find traction. So really, two different things we were weighing with at least the leading contender finalists. I see Martin, you have a question. I'm sorry for not seeing that right away.
Yeah, no worries. Hi. So I'm not an investor in the SPAC 6, but I know that John and other kind of angel investors and venture capitalists always talk about, you make 30 investments and one is the winner, and then you have kind of 25 busts and a couple of kind of break even. So in this particular case, how good was it? Was it, a 10x, 100x, 1000x kind of thing, just for reference? Because it's easy to forget that even the good cases is sometimes not as good as you think, but maybe this one was. I have no idea.
That is a great question, and it actually even if I don't have the exact numbers, which is kind of goes back to the conversation a few minutes ago, which is we're waiting to kind of figure out, now that the going public process and the SPAC process is all has completed. Our fund, and I'm sure the other investors are all kind of we're wondering, where did that land us on our ownership percentage? What number of shares do we actually hold in the company? And that when we find that number out, then we will be able to compute we'll be able to compute an ROI multiple based on, you know, the current stock price, which is the share price on New York Stock Exchange, which is, you know, which is fluctuating but holding in a place we really like, right? So, but I mean, this is absolutely at today's share price, right? Sort of where it's at. It is a very, you know, it is definitely in excess of what we consider to be the top end of a great angel investment return, or at least a multiple, right? Angel investments, what we generally say when we're learning in SAC and as we execute, we look for companies that are going to exit in hundreds of millions of dollars of valuation, right? And this one definitely exceeded that. But more importantly, we want to see an ROI that's we think a 10x, 10 to 20x range. And more importantly, again, as in the case of this, we're now looking at 7 to 8 years of having since we made the first investment. Our internal rate of return, our IRR, we basically aim for wins when we're investing that will put us in the 50 to 100% IRR range. Now, we only expect, that's not our portfolio goal. Our portfolio goal is beat the market, right? But on what we're batting for on any individual deal is we want to see the potential of an IRR that is 50 to 100%, you know, in that range by the time the exit happens. And I'm pretty sure, I haven't done the numbers, but the numbers at what we do seem like we have the ability to hit that with this one. And so, but again, that reflects by the numbers in angel investing. You hope that 10% of your checks you write are going to fall in that, right? And you expect that 90% are going to be nowhere near that. Milton, you're kind of my compatriot in valuations and returns. Do you have any thoughts on that?
Well, the thought that struck me when you're talking about, you know, capital intensive investments was, you know, you kind of make these rules, and then every time you look at history, there's exceptions to the rules, right? And so I've heard, you know, capital intensive type companies oftentimes get a bad rap, or we shy away because the returns may not be so great. But it just shows that you have to be a little bit, you know, every case is different and every company is different. And so I think the questions have to be different in their due diligence, which they were, when you have a company that's, you know, is going to need a ton of money to reach the end goal. It's like, so then the question should be not, oh, we don't want to do that. It's like, can they get a ton of money? Do they have the proper, you know, venture scale connections and, you know, makeup to do it? And I think we did an okay job of that, but I have heard repeatedly that the you know, capital intensive kind of run away. And I think we took a good approach on SAC 6, maybe because we were naive, but it just goes to show that every time you try to make a rule or a guideline, one has to kind of like challenge it, I guess.
We lost out on a lot of angel investment because of the perceived capital investment required to scale the organization.
Yeah, and it's a hard challenge, but any startup has hard challenges. And so it's just another challenge that should be looked at with all the others and say, can you meet it? You know, is it likely, is it possible that you can do it? And obviously you guys did. Awesome.
And can I just ask a follow-up question there? Because a lot of other angel investors say that they want to save money for follow-on rounds to be able to kind of invest in the winners. Do you feel, as a SAC fund manager, or you know all the other participants here, that you kind of lost out on that opportunity, or were you able to kind of benefit from that through some sidecar or something else, or did you just lose that kind of extra investment opportunity in the following rounds?
Great question. Yeah, this is good for this level. I think we may have lost the broader audience if we had addressed this earlier. We did have an opportunity to exercise pro rata rights for the Series B, and we did look at it at the time. I forget what year that was, and we didn't do it. There were a couple reasons. Now, I think Angela said that Portland Seed Fund wisely did, but what as the fund manager, we did do a spin on that. We looked at it. What was tricky was, we had 26 investors that I put the question out to. Hey, what does everyone think? And now, and I got 3 or 4 people that participated in the conversation. Milton, you were one of those back at the time, I think. And it was kind of like, we were still operating as I was leading it as sort of like a group decision. Now and it has to be a group decision because we would have to have the funds to invest. But it was also kind of an administrative hassle, right? If I have only 3 or 4 of the 26 who were interested to go in, that's not going to be enough. That's not going to raise enough money. The Assure Fund Management Company isn't going to spin up a special purpose vehicle to do that. So it was sort of a combination of, and plus, I really think at the time of the Series B, it was a lot harder for us. We weren't in a position to really go back and do a due diligence. So I wasn't going to go knock on your door, Craig, and say, hey, will you spend an hour and a half or 2 hours on the phone with us to answer our questions to see if we want to do another 100,000 or 50,000 or something like that. So in hindsight, I think that's for in the future, this has informed my decision process for how to evaluate opportunities to exercise pro rata and participate in subsequent rounds. But every opportunity, every company and every round is a little different.
I think it's important to remember what SPAC is and its purpose. Also it's, it was sort of meant to be a training ground for new angels and a opportunity for experience. And everybody's has the potential to make their own move. And once you know the company, and with enough money, I don't think Craig would have turned it down if enough of us got together and said, here's some money we want to invest. Obviously, they probably don't want to take little tiny checks, but it's something to keep track of all your companies and say, hey, who's killing it, and can I keep on going? And oftentimes, whether you have pro rata or not, if you can structure it well, you can get in or stay.
Hey, Brian, you have your hand up.
Yeah, just curious for Craig. I'm creating a company to control when electric cars charge and shift them to the best time of day. So we're providing demand flexibility as a service to utility. I was just curious, when you went through finding investors, was there some magic set of investors that already understood, demand response and the Western EIM, or were you always educating investors on this sort of thing, or did you just try to never use any terminology like that in your pitches?
Always educating investors, and frankly, we're constantly educating our customers. Right, it's a constant battle. It's an abstract, right? It's abstract thinking, right? Most people will just put gasoline in their car, right? So trying to understand moving tariffs or times of charge around to meet tariffs, it's just people don't even understand it, right? Pacific Northwest, they pay 7 to 9 cents per kilowatt hour for electricity. Mm-hmm. That's who you're reaching out to. They don't understand that. In California, it's 50 cents per kilowatt hour during peak times, and it's 10 cents per kilowatt hour during non-peak times. They just don't get that. Or there's peak charges just if they use over their normal baseline amount, right? They don't get that. And even if folks in California don't even get it 90% of the time. So it's a challenge. So a lot of graphics and cartoon pictures with crayon works best.
Got it. Thanks a lot for the information.
We still struggle with it today. Our battery doesn't operate like a lithium ion, doesn't operate like a lead acid battery, but people tend to think they need to trickle charge it, right? You don't need to trickle charge our battery. It's a flow battery. You can just shut it down. It doesn't self-discharge. So there's a bunch of, how you operate things. It's just abstract for people. They just don't get it yet.
Got it.
It's a tricky marketplace.
Yes, I found that out too. So thank you.
Thanks very much. I see Rob has his hand up. let's call that the last question since we're at time.
Yeah, thanks, John. Digging into some of the technical stuff, Craig, thank you very much. I have a bit of a technical question. I have a friend who did some research into using your batteries for an electric bus charging company up in Wenatchee. And at the time, he learned that the temperature would be an issue, if it was going to be exposed to freezing temperatures. And I wanted to learn a little bit about your answer to people that live in colder climates. I know it goes down to something like something below freezing. But if you're going to have an Austin, Texas situation, would your batteries need to have supplemental heating to stay active in those really cold freezes?
So the battery itself operates at around 55, 60 degrees centigrade. It's like 140 degrees Fahrenheit. That's
Okay.
the temperature that the battery operates in. As long as you're cycling the battery, we can operate, I think our spec sheet is minus 20 degrees C, it'll operate as long as you are cycling it. If you're not cycling the battery, it'll cool down, but it'll cool down over a period of multiple days, just because there's so much thermal mass. And so typically in those types of events, when we have people who want to operate in a very cold climate, they're not going to be operating it very consistently. We do have a cold weather package that we can provide, but that's energy that's going to be required, right, to keep the battery up at temperature, because we won't provide full rated power if the battery is below a certain temperature, just for efficiency reasons and durability reasons. So certainly down in the hot climates, it's not an issue for us. But the very cold climates, if you're not cycling the battery on a consistent basis, you'll need the cold weather package. We've talked to people in Alaska, and one of the ideas was we could put the battery in another building and just climate control the building, and so you don't have to worry about the ambient temperature as much. So that's another opportunity as well.
Okay. Yeah, great answer. Yeah, that answers it. Thanks.
And that's something our Energy Center product line does, right? So the Energy Warehouse is a containerized solution, so that'll need a cold weather package to meet that environment. But the Energy Center, which is much larger, it's like 10 megawatts and above, those are batteries in a building type idea, right? They look like data centers, and so they're already in a building.
So yeah, it could be in a heated building. Yeah.
Correct.
Yeah. Okay, thanks.
Yeah.
I was gonna actually, I'm glad you raised your hand on that, because I remember that was a question you brought up a couple of weeks ago, Rob. So it's like, here's the opportunity.
Yeah.
Great. Well, thank you, everybody. I think and really, Craig and others, thank you for your extra time here today. I think we had promised sort of 90 to 120 minutes, and we've gone over, but the conversation was great. The questions were great, and all the insights. So thank you again.
Yeah, thanks for having us.
Yeah.
It was wonderful to have you all here. Thank you.